Welcome back on the Blockworks Macro YouTube channel. This is Alf speaking. You know me already by now. The guest today is a friend of mine and actually a young prodigy. How old are you, Sri? 19, I think by now, probably. He's a 19 years old, correct me if I'm wrong, young guy, or 18 years old, young guy who hosts a very successful and super good podcast called Market Champions. He interns at Simplify with Mike Green, and he knows more about macro than many of the people I worked with, which were at least double his age. Srivatsan Prakash, pleasure to have you here, Sri.
It's awesome to be speaking to you, Alf. Thank you so much for having me on.
So, Sri, I would say, as I start always these interviews with the main question that is on minds of many people right now, which is, are we going to see a recession? How bad is it going to be? And what is the probability that you attach to a recession hitting us over the next few quarters?
Absolutely. So I think that the probabilities of a recession over the next, say, 12 to 18 months remain elevated. And so you can start by looking at, for example, the orders to inventory numbers. So what we're finally starting to see right now is that supply chains have begun to normalize in many ways. So if you look at container shipping prices, those have headed lower. You're broadly seeing these orders to inventory numbers go down. So what that's telling you is that there are not as many orders coming in to buy stuff, and so the stuff that companies make is starting to build up. And so when you see these inventory builds, what we're seeing is now a shift from shortages to where inventory is actually building up. And where that's interesting is you can look at, for example, the Fed manufacturing surveys that come out, because they always have data on new orders and expected new orders, prices paid, expected prices paid, etc. And those are all coming down. So that's the first thing. That's the first thing that comes to mind when I think about this fundamental shift that we're starting to see in the economy. The other thing is, so we're also starting to see the yield curve invert. So if you look at the 2-10s, for example, we have started to see that they are roughly at the levels they were before the 2008 crisis. And so obviously I'm not calling for a repeat of the great financial crisis. The factors that caused the crisis in 2008 are very different from what we're seeing right now. But it is interesting to see that the yield curve has inverted to that level. And this week, so we're speaking on the 25th of July. So this week, there is a good chance that the Fed hikes 75 basis points. That's what markets are firmly pricing in. The other thing that we saw in the last week are the S&P Global US Composite Flash PMI. So that was below 50. And remember that the PMI is a diffusion index. So every time the PMI goes under 50, what that tells you is that the economy, or whatever indicator, the PMI, it could be, services PMI, manufacturing PMI, etc. But every time it goes below 50, it signals contraction. So what is interesting is we've seen the S&P Flash PMI go under 50. We're starting to see bad earnings, even though we're just 1 week into earnings. Well, we're just really 1 week into the proper earnings season. We're starting to see negative guidance revisions for every sector excluding energy. Copper to gold is another important indicator to watch. And what we're seeing there is we're seeing copper to gold head much, much lower. And where this is interesting is copper to gold seems to have a very good relationship with 10-year yields. And that broadly makes me bullish on long end bonds, especially with the hypothesis of a recession. We're also starting to see liquidity tighten. We're starting to see the housing market take a dump. These are broadly factors that seem to tell me that the probabilities of a recession over the next year and a half, it tells me that the probabilities remain elevated.
So you presented, I think, 5 or 6 forward-looking indicators, or anyway, interesting macro indicators to look at. They're signaling, in your opinion, we might be close, or anyway implying that recession probabilities are higher than many people discount. Let's actually talk about them for a second, right? So you mentioned first orders to inventory ratios. So there, basically, I guess you're looking at the many subsection of the service, either regional or US aggregate service. Can you elaborate for a second again why this orders to inventory ratio is a leading indicator and what's telling everybody again?
Right. So the orders to inventory ratio, it's a very simple indicator, but it's very powerful. So when the economy is strong, so what we will see when the economy is strong is that a lot of companies will be able to purchase goods. People will be able to purchase goods. And so you would see that new orders number go up and you would not see a build in inventory. And what we've seen over, say, the last 18 or so months is that we've seen to an extent supply chain blockages, etc. And so that has led to a fundamental shortage in terms of what goods people are able to purchase. However, we're starting to see a shift from that because now we're seeing the orders go down. So, demand is going down. And so as supply chains normalize, we might eventually enter an environment where we shift from shortages to a glut in inventory, where the buildup in inventory is what makes it very interesting. So we start to see orders go down, we start to see inventory continue to rise. And, the combination of the two means that companies will be left with more inventory than they're able to sell. And so I read a Substack post last week. And so what that highlighted was the ISM manufacturing new orders index versus the ISM manufacturing prices index. So those have a pretty strong relationship. And if you look at the spread between the two, at the moment, it's at its fifth percentile. And so, if you believe in, fundamental mean reversion, etc. So what is interesting is that, the ISM manufacturing index for prices is higher than the one for new orders. So the one for new orders is turning lower. And if you believe that prices paid would catch up with the new orders index, we are likely to see that the ISM prices index starts to move lower, and indicating that we might see disinflation or even worse, deflation.
So, Sri, I tend to agree that new orders to inventory ratio is a decent forward-looking indicator. It tends to predict both slowdown in aggregate PMIs, but also in aggregate GDP activity with a few quarters, or at least a change in the pace, let's say, of GDP growth, whether an acceleration or deceleration, but also the relationship with prices paid. Obviously, if there is a lot of demand, which is reflected in new orders, and let's not forget this service basically ask CEOs and companies, what about the new orders coming in over the next 6 months? So it tend to ask about potential future activity against a potential build-up or reduction in inventories. So as prospects for new orders are declining, while inventories, we have seen them already in some of the big retailers in America, like Walmart, are piling up, it might be finally some good news as well for inflationary pressures, where at least on the good side, at least, you get some decent disinflation. The other one that you mentioned, which is very interesting, is the yield curve. And then we're going to move to copper to gold, which is also interesting. But let's talk about the yield curve for a second. You mentioned that the spread between 10-year and 2-year yields in the US, so that curve slope basically is as inverted as it was before the great financial crisis, almost there effectively. So why would you pay attention to yield curve inversions in general?
So the thing about yield curve inversions is the important data that it tells you is it tells you about about interest rate expectations from the bond market in many ways. And so where this gets interesting is, so typically the Fed controls what is called the short end of the curve. And so that's roughly 3 months to 1 year, 3 months to 2 year tenor. And then the 10-year to 30-year is typically controlled by inflation, growth rates, etc. And so what this is telling you is that the Fed is hiking, which means that the front end is going higher. And so what the market is basically implying is that the Fed will so generally speaking, for a strong economy, a strong healthy economy, so that is typically marked by a steep yield curve, or at least a normal yield curve where the front end trades lower compared to the back end. And there's various reasons for that. And another thing that's important is that so a lot of bank lending depends on what the yield curve spread is. So if so obviously so if the short so usually banks borrow short and lend long, and so they borrow the 3 month, 1 year, 2 year rates, and then they lend out say 30-year mortgages, and so the rate at which they lend out is determined by the long end. The rate at which they borrow depends on the short end, and so that spread matters because that is the profit that they're trying to capture. They eat the interest rate spread for lunch, and the yield curve has also, at least historically, been a very good predictor of a recession, and usually with a lag of about 12 to 18 months. It's been a pretty good predictor of slowdowns and recessions, and so I think it's interesting simply because once we start seeing say supply chains normalize, demand come down, etc. The inverted yield curve essentially forces the Fed to cut, which would ensure that the front end of the curve moves lower, and then the back end starts to steepen a little bit. So what it tells you is, one, that the market it tells you about the market's expectation, it's the bond market's expectations of what interest rate policy is, and two, it also in a way forces the Fed to undertake actions that would, at least in the long run, help the economy.
Yeah, Sri. So I tend to agree with most of what you said. The way I normally interpret yield curves is the long end of the yield curve is much more reactive to long-term inflationary and growth prospects, while the front end of the yield curve is
more reactionary to
much
what the
more
Fed is
influenced.
saying, etc.
That is correct. So the Fed tends to influence that much more because simply, let's say, a 1 year or 2 year yield is effectively the reflection of where federal funds rate will be in a year or two. And that is very influenced by Fed policy. While if you take a 10-year or a 30-year bond yield, that is influenced by inflation expectations and growth. So when it happens at the front end of the yield curve reflects the Federal Reserve, which gets very, very tight, like it's getting now, right? But the back end of the yield curve refuses to align with that. It's effectively telling you that the monetary policy at the front end is becoming way too tight and is going to actually hamper growth and inflation over the long term. And therefore, sometimes you have long end bond yields which are even inverted, pricing in the fact that the Federal Reserve will have to accommodate, after effectively inducing too tight conditions, will have to accommodate back then even more than proportionately. It tends to be a very good leading indicator for economic slowdowns at the very least, and recession even mostly. And copper to gold, Sri, was also an interesting one because they are two commodities, but they are quite different commodities in many aspects. So can you tell us why the ratio is actually important?
Absolutely. So I think one thing that is interesting to see is that, so for example, if you take copper in USD terms, it becomes very hard. In that case, you tend to have two variables. So you have what happens to the copper market, and then you have what's going on with USD. So if the USD, for example, gets debased, then you would likely see copper prices go higher, even though there is no real fundamental change in the demand and supply in the copper market. However, if you look at copper to gold, what becomes interesting is, so for example, you would expect that China or Chinese economic growth to be influential to copper, considering that China is, if I remember correctly, the world's largest importer of copper. And, they're a big manufacturing economy, so copper goes into, almost every product, etc. So what becomes interesting is, so if you take copper in USD terms, it becomes very hard to regress that against, say, the Chinese credit impulse. However, if you take copper to gold, so gold in a way neutralizes the base of copper. So in a way, what it really does is it isolates for what copper is doing, as opposed to focusing on what copper is doing and what the USD is doing. And if the USD rises, we see commodities fall, etc. You don't have to worry about that when you look at copper to gold. And interestingly, when you run regressions using copper to gold instead of copper USD, you see that it becomes a lot easier to regress. It becomes a lot easier to in a way forecast what's going to happen to the ratio using, say, the Chinese credit impulse, as opposed to using copper USD. The second thing that's interesting with copper is that, so copper, as I previously mentioned, is widely used in manufacturing. It's used almost everywhere, and it's one of the most important commodities. And copper, in a way, is very good at telling us what is going to happen to economic growth. And Gold, on the other hand, is and gold, and so when you look at copper versus gold, what we're really trying to tell here is what is going to happen to economic growth if copper gold goes down. That is a good indicator that the demand for copper is falling down, and therefore what we're bound to see is when the demand for copper goes down, that is a good indicator that the economy is also beginning to slow down. And if you run copper gold against, say, the 10-year treasury yield, you see that the relationship is actually pretty close. And in many ways it helps. In many ways it can help forecast what inflation is going to, what 10-year yields are going to do. And if you look at the chart of copper versus gold, you're seeing that it's absolutely fallen off a cliff. And when you look at that, and when you see that 10-year yields haven't followed through yet, what that tells me is there's a trade to be had. There's a trade to be had being long 10-year treasuries, and basically expecting yields to go down as well.
So, Sri, what you said at the beginning, I found extremely interesting as a way to propose the copper to gold ratio, which is not something very new, I would say, as a ratio, as an indicator, but many people present it as, well, copper is a bellwether for industrial activity or economic activity in general.
Gold is more of a safe haven or an inflation hedge, etc. So
it's a defensive metal, precious metal, let's say. So looking at the ratio will tell you whether the economy is accelerating or decelerating, effective, and also whether sentiment is becoming more aggressive or less aggressive on the economy. The way you presented it, though, was much more interesting because you said, okay, so copper is a commodity and it's priced in dollars. Now, what happens to the amount of dollars? What happens to the denominator? So if there are much more dollars circulating in the economy, and again, dollars that can be spent, not dollars stuck somewhere in the interbank system, but real dollars that can be spent, then obviously this impacts the price of copper because the denominator is changing, right? And now you say, let's neutralize this effect and put gold, because you can't easily print any new spendable gold out of nowhere. And let's see how copper is doing priced in gold. I found that to be a very, very fascinating way to put it. I wanted to move now to China, because you mentioned China a couple of times, both in a global macro perspective, but also related to copper. And I know that you have some opinions about China, both structurally and speaking. So let's have a chat about China. What do you see happening there?
So I think the interesting thing about China is, so from a long-term standpoint, they have a lot of so from a long-term standpoint, so China has a lot of structural issues that just hamper the economy. So the first one that is worth discussing is what's going on with demographics. And so, if you go back, they initially introduced the one-child policy, and then eventually, well, what that led to was a mass. It led to sort of a deficiency in the population. So a deficiency as in the number of people in China. And then the other thing was, so interestingly, I believe a couple of weeks ago, there was some research that came out saying that China overstated its population by about, but I think it was just under 10%, which is quite massive. And so it said that China's actual population was about 1.28 billion, and not the 1.4 plus billion that people usually look at, or that those are the official numbers, but the official numbers are apparently likely not right. Obviously, we would need more research to confirm that. But what is interesting is that if you look at how much the average Chinese household or the average Chinese parents spend as a portion of their median income on, say, their kids' education, it becomes very hard to make an argument as to why we will see more babies being born in China, just because it's become incredibly expensive. It's become incredibly expensive to raise kids and pay for their education, etc. Just within China. And remember that culturally speaking, just within Asian countries and China in particular, education is vital. It is something that is culturally ingrained. It is something that every child has to do well at school. So it is just something that's just culturally there compared to, say, the US, etc. And when you see how much these people, if I remember the number off the top of my head, it was about 40% of their median income is spent on their child's education. So obviously, if you have two kids, then you spend 80%, and you won't have any money left for food or housing or clothing, etc. So that's one of the big issues. So we're starting to see the demographic decline in China. And remember that back in the 70s and the 80s, China had a lot had a lot of young people. We started to see some amount of liberalization with Deng Xiaoping coming to power, etc. And eventually in the late 90s and especially in the early 2000s, from about 2002 to 2006, we saw massive commodity bull market, just driven by China. And so, that was, that was a very powerful time to be, that was a very good time to be long China. China was becoming a very powerful economy. But, those dynamics seem to be reversing. And the second important structural issue that we're seeing is when it comes to the investments versus the consumption function. We've seen Michael Pettis's work highlight highlight this dynamic of how China has focused on investment, corporate investment, etc., as the way to boost aggregate demand. So remember that aggregate demand has roughly 5 factors, or I guess 4 factors. So you have consumer spending, corporate investment, government spending, and then exports minus imports. So what we saw was this I factor, the investment factor, go up, and a lot of it was funded by debt. And debt after a point starts to become unsustainable just because it becomes harder to pay off debt. And then the return that you generate with every additional dollar of debt that you borrow may actually be lower than the cost at which the cost of the debt itself. And so what Michael Pettis has argued is that we need to see fundamentally a shift from this investment function to the consumption function, and we need to see that we need to eventually start seeing these debt levels come down, because it is just unsustainable to keep borrowing money and spending it, and a lot of the spending tends to be, or at least some amount of the spending tends to be wasteful. So we've seen the advent of stuff like ghost cities, etc., just within China. And then the third and very important thing that we've started to see over the last few years is the strong grip of the Chinese Communist Party on regulation. So we started to see the tech crackdowns. After that, it just becomes very hard to have the promise of property rights as an investor in order for capital to flow to China. And so I think, fundamentally speaking, China is just very unattractive as a country to put any amount of money in.
Yeah, Sri, I had similar considerations when looking at the demographics in China. I think if you look at the labor force since the 80s to 2020 doubled. It's ridiculous. It's a huge pace of growth. But now if you look at the fact that it takes 20 years, 0.7 to make it 20 years old, and you look forward to the next 2 to 3 to 4 decades, you actually see this likely to reverse back. And as the labor force shrinks, it's very difficult to engineer growth, if not, as you said, via debt and leveraging. But obviously, if you look at private sector debt in China, we are at levels that are incredibly high. They're as high as Japan during the real estate bubble, or many other jurisdictions when they started having some sort of bubble or problems. And we are seeing already some big, actually, real estate deleveraging in China, with some big defaults across developers. Don't forget, China is a $55 trillion real estate market. It's the biggest real estate market in the world. Talking about real estate, I just wanted to move to the last point of this interview because you live in Canada. And talking about places with high private sector debt and a very large and buoyant real estate market, it's time we talk about Canada for a second. So what's going on there?
So what is interesting about Canada is there's a lot of structural supply issues when it comes to the housing market in Canada. And so it's obviously easy to start blaming, the central bank. Central banks kept rates too low over the last 10 years. And that's why we're seeing this. Or, it's the easy money and the money printing. And so that's why. So, but, I would firmly disagree. And so, obviously mortgage rates have had some impact on the demand for housing. But I would argue that a large portion of the reasons behind why housing is so expensive in Canada is related to supply issues. So if you look at Toronto or Vancouver, and if you look at the suburbs of Toronto or Vancouver, the way these suburbs are constructed is, so they have a lot of single family housing. So they have a lot of houses as opposed to apartment buildings, etc. So when you have these houses, what ends up happening is, so on a plot of land where you could say build an apartment, you instead have 10 single family homes. And so an apartment, let's say, a 15-story apartment with say 10 units on each floor. So that would have 150 units of housing in total, just on the same plot of land as those 10 houses. So if you have 10 single family homes, imagine we just get rid of those homes and we build an apartment. And so the apartment can now house more people compared to those 10 single family homes, and it's exponentially more people. It's 15 times as many. In a 15-story, 10 unit per story apartment, which are very common in terms of the apartments in Canada. Even though the most common mode of housing is the single family home. And so what is interesting is that the government has effectively banned the construction of apartments by introducing what are called zoning laws. And so what they do is they split up the city or the suburbs into zones. And so they say that within this zone, or they split up into pieces and say within this piece or within this zone, you can only construct single family housing, or within this zone, you can construct apartments. The problem is that a lot of this land is either barren, so it contains forests, trees, etc., or it's got single family housing. And so what we're seeing is this structural shortage in the supply of housing, which could have been fixed simply by introducing new apartments, by just constructing new apartments and drastically boosting the housing supply. The other dynamic that becomes a problem here is that the incentive structure of voters is misaligned. So remember that the average voter is usually older, so it's not teens like me. It's people who are older and they already own a house. And so if we started constructing apartments, what ends up happening is the value of their house starts to go down. So the price of their house or their biggest asset starts to decline, and they don't want that, because their biggest asset is their house. It's worth 1.2 or 1.5 million. Why would they want that to come down to say 800,000 or 400,000 just so poor kids like me are able to buy a house? They just don't want that. And so the other interesting thing was in Vancouver, it is easier to get a pope elected to the head of the Catholic Church than it is to get an apartment building approved in Vancouver. And so what it just causes is this massive difference between supply and demand. And so we're starting to see Canada requires a lot of immigration. We're starting to see immigration, and then to some extent the real estate prices are boosted by some amount of Chinese money laundering, and there's evidence for that. And the problem is that the Chinese, or at least a bunch of the Chinese who are typically affiliated with the government, they have so much money. They just come to Canada, buy a bunch of property. It just stays empty because no one lives there. It's just a place for them to park their cash. And so that is another leading factor to why why Canadian real estate prices are so high. But the biggest problem is the supply restrictions, and just in general, the fact that we just don't have enough houses, and government simply will not allow the construction of more houses.
So, Sri, instead of hearing a rant about central banks pushing up house prices, a very interesting perspective on the fact that both regulation and other incentive schemes, extremely interesting, the voter story. Indeed, if your balance sheet asset side is composed 80% by house prices, what's your incentive scheme to vote for any regulation or any party that's going to push regulation against that?
Exactly.
So one silver lining maybe is that hopefully the demographics of voters in Canada and elsewhere is going to change. Not hopefully, but it's a fact. Mm-hmm. It's going to change over the next 8 to 12 years. Still some time to wait until more friendly regulation for house supply comes online. We should get there. Sri, the last thing I want to ask you in this interview is, I personally am utterly impressed by your ability to talk about global macro at the young age you are. Some of this ability has been developed due to your podcast, which is called Market Champions. And I really, really enjoyed that. But I would like you to present for a second, what do you do in this podcast for how long has been going on and how does it work?
Absolutely. So I started the podcast back in January 2019. I think it was 14 back then. And so the podcast is dedicated to interviewing practically the best minds, the smartest people when it comes to economics, markets, and finance. And Alf, you've been a guest in the podcast, I think, a couple of times or so. And so we move, and so a lot of the discussions revolve around macro, revolves around discussions like interest rates. What's going to happen to the dollar? What's going to happen? What's going to happen within the economy? Are we going to see, or are we going to get a recession? And what's going to happen to interest rate? What is the Fed doing right now, etc. And it is a general finance podcast. A lot of the content is definitely based around macro, but again, I've had people who are quants. I've had individual equity people, long short equity people. I've had a couple of venture capitalists, etc. And so that's what it's dedicated to. So you can find that by just Googling Market Champions, or you can go on to a podcasting platform of your choice. So you can take Apple Podcasts, you could take Spotify, or Google Podcasts, or whatever, Stitcher, whatever platform you prefer, and then just search up Market Champions, and you should be able to find my podcast there. And so it's also on YouTube. The funny thing about YouTube is it's a lot harder compared to the audio medium, just because on YouTube, if you make clickbaity content, that goes that goes very viral. If you're like, is the market, are we going to see the housing market crash? And then with like a funny face, and then it's just those are the videos that end up going viral, and so YouTube has that interesting dynamic to it. But yeah, so if you want to go find my podcast, that's the best way to do it,
guys. And honestly, it's one of the few podcasts I listen to every week. It's a good content, very well based, very informative macro podcast. It's called The Market Champions. Go and visit it. Sri, thanks for being here with us on Blockworks. By the way, guys, talking about channels, if you want to hear more of these interviews, just subscribe to the Blockworks Macro YouTube channel, so you get a ping every time there is a new video on. Sri, thanks for being here, and we'll talk soon again.
Thanks for having me, Alf. It was awesome to do this.